A metal that was trading at $18 5 years ago just touched $121 in a single session. Then it dropped $35 in one day, the largest intraday collapse in silver's history. That same metal is sitting inside your phone right now, running through every solar panel on your neighbor's roof, embedded in the guidance systems of missiles being fired over the Middle East as we speak. And for the past 6 years, the world has consumed more of it than it has produced. This is not some obscure commodity story buried in the back pages of the Financial Times. This is one of the most important supply and demand imbalances on the planet, and it is playing out in real time, while most Americans have no idea it is even happening. Let me walk you through what is actually going on with silver, what is real, what is hype, and what it means for your money. This is Hidden Economy. The first thing you need to understand is the sheer scale of what just happened to the silver price. In January 2020, silver was trading at about $18 an ounce, roughly where it had been hovering for years, and nobody was particularly excited about it. The metal had been range-bound between $14 and $20 for the better part of 5 years, and most investors treated it as an afterthought compared to gold. Then the world changed. COVID hit, governments printed trillions, inflation exploded, and precious metals started moving. But silver did not just move, it detonated. In 2024, silver returned about 21%, which was respectable, but not extraordinary. Then 2025 happened, and the metal surged 148% in a single calendar year, going from roughly $29 at the start of the year to over $70 by December, making it one of the best-performing major assets on the planet. And then January 2026 arrived, and silver went from $70 to a record high of $121 on January 29th before crashing back down to $86 within hours. As of right now, in mid-March 2026, it is trading in the range of $75 to $80 per ounce after a brutal pullback, still nearly 4 times higher than it was just a year and a half ago. So the obvious question is, what on earth is driving this? And the answer is actually not one thing. It is a collision of at least 4 forces that all hit at the same time, and understanding each of them separately is the only way to make sense of what happens next. The first force is industrial demand, and this is where the story starts getting really interesting. Silver is not just a precious metal that sits in a vault. It is an industrial workhorse. About 800 to 900 million ounces of silver get consumed every year in manufacturing, and the biggest growth driver over the past decade has been the solar industry. Every solar panel on the market uses silver as a conductive layer. The photovoltaic sector alone accounts for roughly 17% of total global silver demand, according to Reuters. And as countries have accelerated their solar installations, the appetite for physical silver has grown faster than mines can produce it. But here is where things get complicated, because the very success of silver has started to undermine one of its biggest demand stories. With silver paste costs per 450-watt solar module jumping from about $5.22 in early 2025 to nearly $17.65 as prices surged, manufacturers are scrambling to find alternatives. 2 of the largest solar panel manufacturers in China announced in early January 2026 that they are transitioning from silver to copper in their production lines, with one of them claiming the switch would be complete by the second quarter of this year. That is a 3-month timeline, which tells you the research and development work has been going on behind the scenes for a long time. Now, a lot of silver bulls pushed back hard on this news, arguing that you cannot simply replace silver in solar applications without degrading performance. And to a degree, that is true. Silver has superior conductivity. But when you have teams of hundreds of engineers at companies spending tens of millions on R&D, and they are publicly announcing a transition timeline, dismissing that out of hand is what you might call selective comprehension. These are manufacturers with their own labs, their own testing data, and their own profit margins to protect. When silver triples in price, the economic incentive to substitute becomes overwhelming. And industries have a long history of finding workarounds when commodity costs threaten their margins. The second force is the supply deficit, and this is the one statistic that the bullish camp relies on more than anything else. According to the Silver Institute, the silver market has been in deficit for 5 consecutive years, from 2021 through 2025, with cumulative shortages approaching 820 million ounces. That is roughly an entire year of global mine production that has been consumed but not replaced. The Silver Institute projects a 6th consecutive deficit in 2026 of around 67 million ounces, even as total supply is expected to rise 1.5% to a decade high of 1.05 billion ounces. Those numbers sound alarming, and they are real, but context matters enormously. Global above-ground silver inventories are not zero. There are billions of ounces of silver sitting in jewelry, decorative items, industrial scrap, and investor holdings around the world. When the price goes from $30 to $90, some of that silver starts moving. Scrap supply increases, jewelers sell, investors take profits, and that is exactly what has been happening.
Refineries in the U.S. are already backed up, processing the flood of generic silver coming back from retail investors.
One major refinery lowered its purchase price to $15 under spot for generic silver, and extended payment terms from 2 weeks to 3 to 5 weeks because they physically cannot process the incoming metal fast enough. A smaller refinery has stopped accepting scrap silver entirely. This is a pattern that has repeated itself at every major silver price spike in modern history. In 1980, silver touched $50 an ounce on an intraday basis, and within 2 months, it was at $10.80. In 2011, silver again touched $49 and some change, and within 5 days, it was back at $32. The economics of mining, scrap recovery, fabrication substitution, and investor profit-taking create a ceiling that the price cannot stay above for an extended period. That does not mean silver cannot go higher in the short term. It absolutely can and might. But the idea that $90 or $100 or $120 silver is the new permanent floor ignores the fundamental mechanics of how commodity markets have worked for centuries. The third force is investment demand, and this is where the money really is. In 2025, investors bought 203 million ounces of silver through ETFs alone. That represents 18.6% of the total newly refined silver supply for the entire year. At the end of December 2025, ETF holdings stood at 1.2 billion ounces of silver. To put that in perspective, in 2022 and 2023, investors were net sellers. They went from unloading silver to buying nearly 1/5 of the entire global supply in a single year. That massive swing in investment demand is the primary reason the price went from $29 to $70 in 2025. Anyone who tells you differently does not understand what drives the silver market. But investment demand is a double-edged sword, and this is the part most YouTube channels will not tell you because it does not generate clicks. A significant portion of the investors who bought silver in the second half of 2025 were not traditional long-term physical holders. They were momentum traders, speculative investors, and short-term opportunistic players who saw a price going up and jumped on the train. These are not people who plan to hold silver for 10 years. They have a 1 to 5 year investment horizon at best, and when they see a 148% return in a single year, many of them take profits. The data proves this is already happening. In the first 15 trading days of January 2026, ETF investors sold a net 15.8 million ounces of silver. 7 of those 15 days saw net outflows. On January 1st alone, investors sold 6.9 million ounces. This is happening at the same time the price was making all-time highs, which tells you that the smart money was selling into the euphoria, while retail investors were buying the headlines. There's an old saying among mining executives that you are not really a mining executive until you have sold a gold mine. The same logic applies to investing. Buying is only half of the equation. The people who bought silver at $30 and sold at $90 made a fortune. The people who bought silver at $90 because someone on the internet told them it was going to $200 and are now watching it trade at $76 are learning a very expensive lesson about the difference between investment and speculation. The fourth force is China, and this is the wild card that nobody can fully predict. At the end of December 2025, China announced new export restrictions on silver starting January 1, 2026. Only 44 companies would be granted export licenses for silver over the 2026 to 2027 period. Elon Musk himself posted about it, warning that silver is needed in many industrial processes and calling the restriction not good. The announcement sent silver futures spiking and created a wave of panic buying among retail investors who interpreted it as a supply ban. But the reality is more nuanced than the headlines suggested. China's silver exports actually hit a 16-year high in 2025, despite the control fears. The new licensing system is a regulatory review process that Beijing conducts every 2 years for strategic materials, not a blanket embargo. That said, the fact that China elevated silver to a strategic material alongside tungsten and antimony is significant because it signals that Beijing views domestic silver supply as a national security priority, particularly as geopolitical tensions with the United States intensify. The Shanghai Futures Exchange trades silver in 15-kilogram units, which is about 482 ounces, roughly 1/10 the size of a COMEX contract. The Shanghai spot price currently trades at a slight discount to New York, after adjusting for China's 13% VAT and 17% import duty, which tells you that right now, supply in China is actually exceeding demand, despite what the export restriction headlines might suggest. These are different markets with different structures, different participants, and different price dynamics, and conflating them into a simple narrative about silver shortages misrepresents what is actually happening on the ground. Now let me bring in the geopolitical dimension, because this is what turned a strong silver rally into a parabolic blow-off. On February 28, 2026, the United States and Israel launched joint military strikes on Iran. Nearly 900 strikes in 12 hours, Iran retaliated by disrupting traffic through the Strait of Hormuz, locking up roughly 20% of the world's oil supply. Oil prices spiked to nearly $110 a barrel. Gas prices in the U.S. jumped 17% within 2 weeks, and every safe haven asset on the planet caught a bid. Silver, which had already been pulling back from its January highs, immediately bounced. Gold pushed back toward $5,000 after its own pullback. Platinum hit record levels, and the entire precious metals complex became a shelter trade for institutional money fleeing equity risk. The problem with war-driven rallies is that they tend to be violent in both directions. If the conflict escalates further, precious metals go higher. If a ceasefire materializes, the risk premium evaporates overnight and you can see sharp sell-offs. This brings us to the core tension at the heart of the silver market right now, and it is the single most important thing to understand if you are trying to figure out what to do with your money. On one side, you have genuine structural factors that support higher silver prices over the medium term. 6 consecutive years of supply deficits, rising industrial demand from the energy transition, even if solar substitution reduces silver's share somewhat, geopolitical instability that shows no signs of calming down. Central banks continuing to buy gold at elevated rates, which creates a rising floor under the entire precious metals complex, and a U.S. dollar that lost 10% of its value in 2025 and is currently struggling to hold the 100 level on the DXY index. On the other side, you have forces that create genuine downside risk, short-term speculative investors who have already begun taking profits, solar manufacturers actively substituting copper for silver, 19 billion ounces of known mineable silver reserves that will eventually be developed as prices make new mining projects economically viable. Hundreds of millions of ounces of silver sitting in jewelry, scrap, and investor inventories that will flow back into the market at high prices. And the simple historical fact that every single parabolic spike in silver's history, every single one, has been followed by a devastating crash. Not a correction, a crash. The difference between understanding both sides and only hearing one side is the difference between investing and gambling. The silver promoters who have been wrong for decades, the ones who told you silver would hit $100 in 2008, then 2011, then 2020, then tomorrow, those people are now taking a victory lap because the price finally got there. But being accidentally right after 15 years of being wrong is not a track record. It is a broken clock. The firms and analysts who actually have documented histories of accurately calling precious metals prices, the ones who were projecting $40 average silver as far back as 2017 for the 2026 timeframe, are the same ones now warning you about profit-taking risk. They are not bearish on silver, they are realistic. J.P. Morgan projects silver averaging $81 per ounce in 2026, more than double its 2025 average. Bank of America sees a range of $135 to $309 by year-end in their most aggressive scenario. But even the bullish analysts are not telling you to chase the price at $90 without understanding the volatility that comes with it. So what does all of this mean practically? If you already own silver, whether physical metal, ETFs, or mining stocks, you are in a strong position. The structural case for precious metals remains intact. The world is not getting more stable. The U.S. national debt just crossed $38.86 trillion. The Iran conflict is ongoing. Central bank gold buying continues at historically unprecedented rates. The dollar's share of global reserves is declining. All of these tailwinds are real, and they are not going away in the next year. But if you are thinking about buying silver for the first time right now at $76 to $80 an ounce, you need to understand what you are walking into. You are buying a metal that was $29 less than 15 months ago and touched $121 less than 8 weeks ago. The volatility is extreme. A 20 to 30% drawdown from current levels would be entirely normal and would not invalidate the longer-term bull case at all. The people who make money in commodity markets are the ones who buy during periods of disinterest and sell during periods of euphoria, not the other way around. The most prudent approach, and this is what the serious institutional money does, is to maintain a core physical position in precious metals as portfolio insurance, and then trade around that position on a shorter-term basis, buying weakness and trimming strength. That is not exciting.
It does not make for a great YouTube thumbnail, but it is how generational wealth is actually built in volatile asset classes. You do not become wealthy by buying at the top because someone told you the price was going to infinity. You become wealthy by understanding the cycle.
Silver at $75 is not the same opportunity it was at $18, but silver's story, the structural deficit, the industrial necessity, the geopolitical uncertainty, the monetary debasement, that story is far from over. The question is whether you are patient enough and disciplined enough to play it correctly, or whether you are going to let the hype machine dictate your financial decisions. That is it for today. This is Hidden Economy.